Thank you so much, Professor. What an incredible speaker he was. I guess, with all that experience as the former VP of World Bank and advisor to Nelson Mandela. I have to say, really enjoyed your insights. I was very pleased to hear your optimistic outlook for the years to come, even with the big challenges that we're seeing with the pandemic, with climate change and geopolitical tensions as well. And that was really interesting to hear your thoughts about the UAE really being placed at the center of globalization and the opportunities that can bring. And I think you're quite right about Dubai being such a center of action, as we can, often see with a lot of these big events. There's often a lot of talk, not a lot of action. And I think, Dubai has really done that differently. We look at what they've achieved with the incredible Expo 2020 Dubai as well. So thank you so much for your time this morning. I really appreciate it. I'm just going to ask if we can get a microphone for one of our speakers down the front here in just a moment. Our next presentation today, we're going to be focusing on global capital from a Middle East perspective. Now, in an incredibly challenging environment, how can MENA region countries ensure that they are attracting and taking full advantage of foreign direct investment? This is particularly vital as the region looks to expand and create job-rich growth. We're very pleased to have a special industry insight for this session. Please join with me in welcoming to the stage Ian Albert, the CEO of Colliers MENA, and Chris Pilgrim, the Director of Global Capital Markets at Colliers, who will be presenting together. There's also going to be time for a few audience questions at the end. Thank you.
Good morning, still. Your Excellency, ladies and gentlemen, good to see so many familiar faces again. Well, foreheads anyway, the mask on. I'm good to see you. The last time we were together, I think, was 19 in a conference in Dubai, and the conversation then was also about change. And the conversation then was AI, the change in working practices. It was the change in what's happening to the office market, what's happening to the retail market, what's happening to the industrial market. And now it's the same conversation, but it's changed again. So now, previously we were talking about office space and co-working. Now it's working from home. Previously we were talking about retail and is it dying? And now we're talking about the rebirth of F&B in destinations. And previously we were talking about, as the professor also mentioned, we're talking about industry and logistics and last mile, and now it's all about global supply chain crisis. But I think from what I'd like to do briefly before I bring my colleague Chris on, who's going to do the global markets, what I really want to talk about is something that's under our noses. And when I say under our noses, I don't mean the PCR test. I'm talking about something that I think we've lacked in this marketplace. I'll step back a little bit. 2014, there was a report by Grosvenor Estates called Resilient Cities. And effectively what Grosvenor Estates came up with was a new way of looking at property investment. And it took two different lumps of assessments, one called vulnerability, how vulnerable is the economy or the city to climate change, industrial changes, overall economic changes and governance, and adaptability was really about governance and how quickly it could change itself. And the difference, and the outcome, of those two numbers really was a product called resilience, which the professor also touched on. And I want to talk a little bit about that resilience and how it impacts and where I think we're missing out on this market. What's happened in the global investment market has been a shift from the traditional shopping malls, offices, and industrial parks. Since 2008, the investment from funds and institutions into the residential investment market has grown fivefold. In the last 5 years alone, residential investment has grown by 30% in Europe from funds. This year, a fully 25% of committed investment funds money has gone into multifamily, i.e. residential investment. Why are they doing it? Well, they're doing it because, first of all, it's a good cash business. If you look at the cash receipts, i.e. the rental collection rates of the various funds this year, residential receipts, multifamily receipts, residential receipts come in about 95 to 97% rent collected. Office, industrial and logistics is quite high, it's about 85 to 87%. And in third place comes in to office space, which is around about 70-75% rent collected. So if you look at it in terms of a cash-on-cash business, it wins. The other issue, of course, is underlying issues. Underlying issues is a shortage of housing pretty much everywhere in the world. That's undersupplied. And then that's also underpinned by a growing population rate, albeit relatively low. So you've got these three factors coming together. Now, if we then look at what's happened because of that, you've got this flood of money coming into institutional residential investment, multifamily investment, and what's happened in the last 2 or 3 years, or in the last 5 years, is that the volume of cash going into it, as I say, this year alone, 25% of investment, the volume of cash going into it has increased prices, decreased yields. Average yield on residential investment in Europe this year is 3.25%. The highest capital growth rate in Europe this year was about 45% coming out of something like Munich, and then averaging around about 25%. So 3.25%, 25% average. Let's start with the UAE. The UAE market, total available for foreign investment, is somewhere around about $350 to $450 billion worth of assets that are out there now that foreign investors can buy in this marketplace. If you look at the returns, just taking Dubai for an example, look at the returns in Dubai this year, capital growth, average, I know we've seen a lot higher than this, average is around about 30%. Yields and returns, cash on cash, is around about 4.8 to 5.2%. So on both of those metrics, you're better than Europe. You're better than where the funds in Europe are putting their money. If we then move on to other opportunities, the Saudi Arabian market has around about, we identified in a report recently, there's around about $100 billion US dollars of opportunity within the Saudi market. Now, that's an inward-facing market for now, but it has some active REITs. But if we look at the REIT and the fund penetration into the Middle East, either internally or externally, and I know there's some conversations to be had later on today, and I'm sure one of my colleagues from Peninsula Real Estate is going to have some interesting chats about this, there's a very small percentage of real penetration. So going back to my point on resilience, and then I'll introduce Chris, because he's far more intelligent, erudite than I am. When you talk about resilience, you talk about adaptability. Who can adapt better, and who has adapted better and shown they can adapt better to businesses and react better and provide better coverage in the pandemic than the governments in Saudi Arabia and the UAE. They've been dynamic, they continue to be dynamic, they continue to address the problems that we have. If you want to look at returns, we're already higher in Dubai. The rest of the Middle East is following. And if you want to look at depth of market, we've got population growth which outstrips the rest of the world. So I think if you look at all the metrics, my message is very simple. The Middle East is undisturbed in terms of institutional investment into the residential real estate multifamily market. And with that, I shall stop going on and I'll drag over Chris, who will cover the really intelligent stuff. Chris.
Your Excellencies, ladies and gentlemen, and of course Ian, thank you all for that very warm welcome, and it's a pleasure to be here speaking to you all today in Dubai. I think both Ian and Professor Ian earlier have raised some really fascinating points around the Middle East being a really attractive place for investment to come into. But I think what I'll go into in a little bit more detail as we look at global capital flows generally is that real estate has become an asset class of major interest to pension funds, sovereign wealth funds, institutions, and there's a real diversity now, both geographically, currency, but particularly in sector class as well, within the real estate asset class that we're going to see. So just a little bit in terms of what we're going to talk about today, I thought it'd be good to have a little bit of a macro view in terms of obviously this very volatile time in the global economy we've seen, and how that relates to real estate. Ian has touched on that sectoral shift. You know, we're seeing far more investment, and this is now on a global scale, moving into the institutional residential class, and of course, industrial as well, and logistics. I think just in context then of global capital flows, we'll look at the Middle Eastern money and how that's beginning to transcend into different geographies and use classes around the world. And of course, I thought it'd be good to leave you all with perhaps some ideas around future trends, which I think, again, Professor Ian has touched on some of those, but specifically how they're relating to real estate investment. And we've put here our recommendations. That might be a bit generous, but I think we'll give you some ideas of what we see perhaps moving forward into 2022. So if we just take a little look at the macro view, and Professor Ian, I think, gave a very good view on sort of what we've seen in GDP growth. I think we have to be careful when we look at 2021. Inevitably, 2020 was negative across the board. And I'm not going to go into all of these, but again, I think, when we look at global growth driven by China and the US, China a very healthy double-digit growth for this year, again, still hovering closer to 10% next year. It's unlikely China's going to hit those double-digit growth sustainably as we've seen over the last decade, but clearly the engine of growth as we move forward. Again, the US, a little bit more sustainability between their 21 and 22 figures, but just again, a huge amount of growth as we move into 2022. Perhaps just then looking at the UK and the Eurozone, the UK, you'll see, has got probably stronger growth for this year than the Eurozone, but you've got to bear in mind that's coming from the benchmark of probably being the lowest performing GDP country in Europe last year. So there's some relativity to that before balancing out as we move into 2022. So just now looking at global volumes into real estate, and the next two slides I think are kind of quite interesting. I think at the moment you can look at a lot of charts and you'll show on a relative basis, clearly 2021 is up from 2020. Not unsurprising given the lockdowns of last year. But what this chart also shows on the left axis is also the relativity on a 10-year cyclical average. And what you'll see, as I find quite interesting, is if you look at the US market, the UK market, and some of those other bigger real estate markets, Germany, Hong Kong, and even some of the European countries, they're not only above their 2020 period, but they're also above investment volumes that have gone in on average over the last 10 years. Looking at it countrywide is quite interesting, but if you then go on to the next slide, this really breaks it down into some of the key cities. And I think Professor Ian sort of picked up on this. When you really break down these big growth areas of the US and the UK, if you actually look at their dominant cities, so London and New York, yes, they are above last year's volumes as would be expected, but they're both still below the 10-year cyclical average. What we have seen a real shift off, though, is more investment in Tier 2 cities, particularly in the US. So you look at cities like Boston, like Philadelphia, like Denver, like Nashville. But again, they're all very much markets far more focused by domestic capital. And I think not only in 2020, but for some of this period of 2021, those domestic markets where capital is not so international, so say London and New York, those markets have probably performed better overall, not only year on year, but on the cyclical 10-year average too. So if we now break this down more into sectors, and again, I think Ian touched on this, what are we seeing in those key sort of 5 sectors? And looking at this chart, moving perhaps from the right side to the left side, it's inevitable in those grey lines there, hospitality and retail are both negative in terms of volumes year on year. Hotels, for obvious reasons, have struggled throughout the pandemic. And whilst we see some signs of recovery in that, clearly investment volumes and investors, both from an institutional and a private level, remain nervous about the sector in terms of a global investment trend. Retail, you'd argue for the last 5 years, has been in decline globally in most major markets. The pandemic, without doubt, has only accelerated that decline in retail as a use class. I think the probably interesting one here, and what a lot of questions come to from us as a business at Colliers, obviously dealing in a lot of office investment, is looking at the light blue graph there. You'll see year on year, office investment volumes are down across the board. In Asia Pacific, 14%, EMEA 28%, and in the US, 27%. I will come on to the next slide, some relativity about that in terms of volume. But where that has been down, we've seen capital being redeployed into sectors across the logistics and the residential, and by that we mean the multifamily sectors. Very much investors are employing the beds and sheds investment strategies, and we've seen that pretty much worldwide. You could argue when you look at those logistics figures in APAC and in EMEA, they're both 50% up in terms of volumes, which in turn has seen relative yield compression. On the multifamily side, the US, 19% up from last year. And again, I think as we've touched on, investors are looking for that more stable income in a maturing asset class. I'll break that down a little bit more in country by country. And the first thing I'll just point on this chart is that light blue graph. And it comes back to that point I was saying about relativity in terms of the office markets worldwide. Although volumes are down year on year, you can see that it still represents a very significant proportion of total global real estate volumes. I think also, interestingly, if you take those top 5 countries, so Japan, Germany, the UK, China, and the US, you're still looking at over $1 trillion worth of real estate investment in the last 12 months. So again, whilst borders have been closed, whilst a lot of cross-border activity has been challenged, we're still seeing very significant transactions. Just to finish on that sectoral topic, you can see now a breakdown of where capital has been deployed from a geographic point of view, but also into a sector point of view. Now, without doubt, and perhaps unsurprisingly, the US remains the dominant market across all sectors in terms of global real estate volumes. And there's a consistency again then with China, Germany, and the UK picking up those other top 4 spots in those major sectors. So as I said at the beginning, that was the very much a high-level view of what we're seeing in terms of total volumes into real estate around the world. What I'll now touch on a little bit is just what we've seen coming out of the Middle East into some of these global markets, both geographically and from a sector point of view as well. So over the last 12 months, again with Colliers research and RCA data, we estimate that there's been approximately $11 billion worth of real estate investment that has come out from the region into other markets. Unsurprisingly, the US and the UK account for 75% of that, but we've seen some other significant transactions in markets such as Russia, Turkey, and France as well. We can break that down even further, and you'll see that there's really a broad spectrum of capital being deployed from this region into other parts of the world. Perhaps when we look at some markets like the Maldives and Vietnam, that's more linked to the hospitality sector, where we see growth of capital from this region moving into worldwide. But it's very clear the UK and the US remain the most liquid markets for capital from this part of the world. So to break that down a little bit more, we've just focused on a few of the highlight transactions we've seen, mainly out of institutional type capital from the region. And I'm not going to go through all of these, but I would like to pick up on a couple, and I think it reflects both the geographic and sectoral diversity we see from capital in this part of the world. At the US, we saw an 89 asset portfolio of real estate assets backed by Omani capital earlier this year. That was 350 million plus US dollars. Moving across again to that sectoral change where we see more capital moving into that beds and sheds strategy, you can see QIA being very active, joint venturing with Credit Suisse on an 8-asset portfolio from Unite of student assets in the UK. And the other one which I think is worth just highlighting here is we are still seeing a strong level of office investment activity, and looking at GII's acquisition in Ile-de-France of over 275 million US dollars. So in context, how does capital from this part of the world relate to what your competitors are doing from other parts of the world in terms of their cross-border real estate strategies? Well, I think not only from the pandemic, we were seeing a trend moving forward anyway, that there is a growth of capital looking to do larger scale transactions, i.e. we would rather do less transactions but at bigger volume. And I think this really highlights that across the board, as you'll see across this chart here. And again, real geographic and sectoral diversity. But I'd perhaps like to highlight, again, moving into those alternative sectors where we see a growth of capital moving. You go to the Netherlands and the high-tech campus, mostly acquired in terms of capital by Singapore's GIC, but a 1.1 billion euro transaction. But it's not always capital just moving from the Middle East and Asia into other parts of the world. We're now seeing US investment fund being very active in markets across Asia as well. And I think Blackstone's logistics transaction in the Guangzhou International Logistics Center in China at $1 billion US reflects that cross-border capital is moving pretty much across region now. The final one I'll just focus on, because I think there's not much discussed at the moment about retail in terms of as a sector, and there's certainly opportunity, I think, available in that. I'm pleased to say our Colliers colleagues over in Australia 3 weeks ago closed a $1.6 billion US retail transaction at the Macquarie Centre, which reflects the largest retail transaction globally since 2018. Again, when we're looking at major transactions and when we're working with colleagues around the world on those particular sales or capital raises, we naturally look at where are the strongest sources of capital. Hong Kong capital has been very strong now for over a decade, and you'll see year on year that's looking slightly down. That's pretty much across the board though. We do think Hong Kong is going to have more challenges in terms of capital coming out of that market, as politically it has challenges. But similarly, we look at a country like South Korea, one of the dominant forces of global capital around the world at the moment, and it's very much down in terms of volume from historically. In 2022, we expect that very much to come back as borders reopen and these funds are investing less domestically and more overseas. If you took capital from the Middle East, that 11 billion US dollars, which I touched on earlier, that would sit somewhere at the moment between France and Switzerland. So finally on this point, and again, I think it's very important to recognize the growth of capital, the allocations from institutions and from funds, pensions, sovereign, etc., only increases towards real estate and real asset. Just in the corporate real estate funds, the dry powder available at the moment is approximately 360 billion US dollars. If you factor that in with leverage as well, you end up with a very significant amount of capital. So when you factor that in across all the other types of investor class, the allocation for real estate leaves us almost with too much capital in the world right now to invest in real estate relative to investable product available. So as I mentioned, we're just going to touch on a few future trends, and I think Professor Ian touched on a fair number of these, but I think it would be wrong to ignore them just purely from a real estate context. So inflation at the moment is, I think, on everybody's mind. Everybody's talking about it. And I think when you look at the labor shortages, labor cost wage rise, and obviously recovery from the pandemic, it's inevitable, not only with inflation rising, but interest rates too. And you'll see very much, I think as Professor Ian touched on, that yellow and grey line reflecting China and the US really leads the way for that inflation. And very much other major economies beginning to follow. The UK now not very far behind, the European Union also moving in that direction. I think bearing in mind those rises and particularly inflationary costs and what that effect is on interest rates, our economists at Colliers think that's likely to level out by the end of 2022 and into 23 without any major sort of increases that are going to affect real estate investment to the extent where it could become problematic. I think it would also be wrong not to touch on ESG at the moment. And again, different parts of the world are at varying stages in their ESG strategies and their policies. But it's certainly becoming a really important topic and obviously very much highlighted and in vogue this week with the COP26 conference up in Glasgow. In terms of ESG, and the reason I'm not going to go a deep dive into this now is it's such a broad topic, but I think from a real estate investment point of view, and when you're thinking about where you invest your capital and which sector you're going to do that, there's various, and I think 3 important things to think about. One is the occupier. How does the occupier view a real estate asset in terms of ESG, i.e. what are the outputs and how does that affect their business? Secondly is from the landlord perspective. How does the landlord develop a building which has ESG credentials which are attractive to the best occupiers who are willing to pay the highest rents? And finally, it's getting increasingly important, even for indirect investment funds, to have a detailed ESG policy in order to attract actual capital into those funds. Just within the European Union zone, we estimate that if you were to hit the Paris climate targets over the next 20 years, there would be 7 trillion euros worth of capital required for retrofit. So effectively, if you're a real estate owner, that's 7 trillion euros of capex. The one thing I would caveat around that is over a 20-year period, but it's also not reflective of potential government support, but also some of those assets have come to the end of their life as well. But I think as a highlight number, it does show the importance of this topic as investors look to invest in real estate and what capex might be required long term. The final topic which I touched on, and Ian touched on this as well, is just corporate real estate yields relative to government bonds. And as we've come off of a historic low, particularly in 21, even with increases in 2022, we can still see the spread, even from the lower end of the spectrum up to the higher spread, that there's still a very good spread of your return in terms of investing in the real estate asset class. The final slide, which I'm just going to touch on, were just some strategies that we find interesting in terms of investment strategies for global investors as they look to deploy their capital. So starting on the right-hand side, with hotels, I think that's going to remain a challenging market, but I think there's clear opportunity for longer-term investors who are able to take a view on that. Some markets are already enjoying real strength in their hospitality markets, particularly with domestic tourism and the staycation type approach to travel at the moment. I think where it's still going to be challenging is for the longer haul destinations, but also particularly around business travel, which we think is still going to take another 3 to 5 years to fully recover. Retail remains interesting at different parts of the world, but as a holistic view, is now the right time to invest. We've seen a decline in the sector, but we also see major markets, London, New York, Paris, those key streets maintain very strong returns for the retail in those high-end markets. But what we are seeing a real shift in is out-of-town retail and shopping centers. Is there a demand, particularly in some of the more established and mature markets? But where opportunity really lies there is values have diminished. And I think that's the really interesting point of where do values get to in terms of do they go any lower and when is the right time to strike? And I would suggest that we're perhaps hovering at that point where you can buy out-of-town retail or a retail park and look at where the real value of the land is. Is it to keep the retail and build residential above? Is it to demolish the retail and build a logistics last-mile distribution center instead? So there's certainly opportunity there. We touched a little bit earlier on alternatives, and I think the more we look at the investment volumes coming around the world, there's going to be far more capital deployed into data centers, into senior living as the population ages, into student housing. So there's definite opportunity around that. But I think the real question there is how do you then manage that asset? They're becoming far more operationally intense, and it's not just a matter of deploying capital into a direct real estate asset and collecting the rent. So we are beginning to see far more operational type joint ventures in terms of those alternative asset classes with sector specialists in their own markets and geographies. Residential here, and again, we refer to multifamily. In some markets, that's very established. So in the US, as I touched on, that was 40% of all volumes on year to date. But there's real opportunity in those emerging markets where people are struggling now to afford their own home to buy, such as in the UK and Australia, both relatively in their infancy in this sector, but there's real opportunity to partner with best-in-class developers looking for indirect capital to help realize the end product. We're often asked, are industrial yields too low? In major markets, we're seeing logistics and industrial yields lower than perhaps some prime offices in Paris, London, and New York. I think the answer to that at the moment is no. We think yields will further compress in the sector, albeit there's strong capital growth as well. There's still a shortage long-term of last-mile distribution, major distribution centers, and that's pretty much worldwide. So both from an operational, from a development, and from an investment point of view, we see a real opportunity in the industrial and logistics markets in the short and mid-term. And I think finally, just to end on with offices, I think there's still huge questions around office occupational requirements. How do occupiers want to use real estate? I think compared to 18 months ago, some of the clear conclusions we now have is, one is employees do want to work in an office, but for how long and how much flexibility does that encompass? And companies ultimately need an office to harness culture and training young people coming through businesses in whatever service line that may be. So at the moment, until there's more clarity in terms of some of these secondary office markets or perhaps some of the assets which are coming more towards the end of their life, we think investing in a core strategy in major markets still reflects very good value in terms of length of income that you can achieve from your real estate. So there is just 6 final thoughts that we have across all use classes. I think it's fair to say that without doubt there is opportunity to invest in all sectors, in all geographies, and as much as we've enjoyed seeing much capital from this part of the world deploy in many sectors and countries around the world, we very much hope to see more of that. And at Colliers, we're very well placed to help do that and assist you with those strategies. And that's the end of that presentation. I did say I'd be very happy to field any questions at this point. I am also on a panel later on and will be around in the room later, so very happy to touch base with anyone as and when. Thank you very much.